market rewarded investors richly in the first quarter of 2019, and we've done really well. Obviously, this is great news, but it begs the question, why is the market doing so well? As I mentioned in my January update, there were really three questions investors were worried about, and they hurt the market in 2018. The first one, will interest rates go up? Number two, will there be an out-of-control trade war with China? And three, are we going to plunge into a recession? Now, I noted in early January that investor and market reactions to those fears seemed exaggerated to me, and I also suggested that if the market gets clarity on these three problems, it could really help investors in 2019. And I believe that's what we're seeing happening right now so far. But is this strength short-term? Are we really out of the woods when it comes to the big threats to the global economy? Let's take a closer look and see. First, we'll look at employment and wages. Now, there are both positive and negative data on the employment front. According to the latest Labor Department report, average hourly wages grew 3.4% annually. Now, that's pretty good. In fact, you'd have to go back to 2009 to find great numbers like those. And unemployment fell to 3.8%. To see unemployment numbers as low as that, you'd have to go back decades. But there's a darker side as well, as always. Our economy only added 20,000 jobs in February, and most economists expected 178,000 new work positions. So that's a big drop, and it gets worse. Total hours worked saw a huge drop as well. Now, in contrast to the numbers above, these numbers point to a slowdown. And this fear of a slowdown is what's behind the Fed's change of heart with respect to the direction of interest rates. And I'll explain more about that in a minute. On top of that, there are global employment concerns as well. The European Central Bank forecasts slowing growth in Europe, and exports from China fell more than 20%. On top of that, planned layoffs in the United States are growing. Now, it's way too soon to call these clouds a Category 5 hurricane. And as I said, some data conflicts with other data in the labor market. But it makes sense to keep our eyes open. That's what I'm going to continue to do. Let's look at retail sales. Along with employment and wage growth, retail sales are also important because when sales are up, it's a sign that consumers are in a good position to buy more goods and services. And obviously that can stimulate the economy. Well, when it comes to retail sales, economists were relieved by the recent reports because they crashed in December and in January they rebounded and they actually beat expectations. Now, some smart people say that the December weakness was an anomaly resulting from the government shutdown last year, and it could be true, but we really don't know for certain. We'll have to see how retail sales do in the coming months before we get a clear picture of the direction of retail. Let's look at interest rates for a minute. As we spoke about a lot, the Fed initially planned on raising interest rates 3 times in 2019. And that was one of the reasons the market did so poorly the last quarter of last year. But the Fed changed course, as I mentioned above, and they announced recently that they may not raise rates at all this year. In fact, there's some speculation that rates might decline this year. Now, will those rate plans hold up? Well, there's a good chance they will. Usually the Fed keeps rates low or lowers rates when they fear the economy is sputtering. And it's never clear which way, 100% clear which way the economy is going, but there certainly are enough signs of slowing to warrant a freeze on interest rate increases. So even though retail sales and consumer confidence and spending are good, recent payroll reports and retail reports are slowing, as I mentioned. And there's more data that points to a slowing economy. As you know, the automobile industry is a big part of our economy, and that area is showing signs of stalling out. Gas station sales dropped by 2%. Car dealerships reported a 2.4% drop in sales, which is the steepest decline in about 5 years. And things could get a whole lot tougher for the automobile industry. All the major manufacturers predict a sales decline for the year 2019. In short, the data points to the picture of a slowing economy, and as a result, It's reasonable to expect that rates won't go up this year, even though the stock market is doing quite well. Now, do we have a Goldilocks economy right now? Well, even though there are signs of slowing, the Fed forecasts a growth in our economy of 2.1% this year. And that's less than the growth of 2018, but it's still expansion. Inflation's at 2%, unemployment's at 3.7%. And if these numbers hold up, it's close to what experts call a Goldilocks economy. Not too hot, not too cold, but just right. Now, there's no guarantee that these conditions will persist. But for now, the situation looks really good. Let's spend a few minutes to talk about China. The trade conflict between the United States and China was an additional speed bump that hurt the market in 2018. Now, the conflict isn't resolved, but it looks like the disagreement won't turn into an all-out trade war. And that expectation that the conflict is mediating a little bit has helped the market. Now, the United States and China have come to agreement on some of the issues, but there are still some disagreements which keep them apart. In fact, President Trump said last week that tariffs on Chinese imports will stay in place for a substantial period of time to make sure that China lives up to any compromise they might reach. Now, what may end up happening is an agreement not to impose the 10% tariffs on 200 billion of Chinese imports, but keep the 25% tariffs on the high-tech and automobile industry imports, which total 50 billion. Now, we don't know if China's going to accept that. And still, as I've said many times before, both sides have a lot to lose if this conflict continues or intensifies. That's why, in my opinion, the trade conflict with China is more likely to be a cold war than a hot one. And assuming I'm right, the market probably won't go into a tailspin either as a result of this conflict. I could be wrong. I've been wrong before. But based on the situation as it is right now, that seems to be the most likely outcome. So stay tuned. I want to spend a minute and talk about the inverted yield curve. Now, when you turn on the TV or read the news or listen to the radio, there's a good chance you'll see the talking heads discuss this inverted yield curve and how it points to a looming recession. So I want to explain what that is and why it may not be relevant this time around. So first, what is an inverted yield curve? Well, I'm not going to go all-out economist on you, but let me explain. Short-term interest rates are usually longer or greater than long-term interest rates. In other words, when things are normal, you get more interest if you're willing to tie up your money for longer periods of time. That makes sense. Now, when short-term interest rates are higher than long-term interest rates, that's called an inverted yield curve. And it means you earn more interest if you lock up your money for a shorter period of time. Now, that happens when the Fed expects inflation to go up. So short-term rates are put up in order to put the brakes on the economy as soon as possible. And when short-term interest rates climb quickly, business cuts back on their borrowing and investing, and that, as intended, slows the economy pretty quickly. And when the economy slows quickly, it can lead to a recession. And that's why economists say that inverted yield curves mean there's a greater likelihood of recession in the near future. Now, that wasn't so bad, right? Not so painful? Okay. Now, the situation today is a little different. For a short time, we did have an inverted yield curve with short-term rates moving a tad higher than long-term rates. But that only happened because long-term rates fell faster than short-term rates. And that happened because the Fed realized they needed to change course, as I explained above, and stop raising interest rates. In other words, short-term interests were a bit higher than long-term interest rates, thus having an inverted yield curve, but that's because long-term rates fell, not because short-term interest rates went up. Now, if this interest rate inversion really indicated that a recession was imminent, the market wouldn't be doing as well as it is. Probably. So again, assuming nothing else drastic happens, rates will likely remain stable and could possibly go down. And if inflation stays in the 2% range and the economy continues to grow modestly, the expansion can continue. Now, the bottom line here is that if we really examine the fundamentals of our economy, things are at the very worst not bad. Yes, the market is high. Yes, there will be corrections ahead. And no, nobody can predict when they will occur. But fundamentally, the investments in your portfolio are solid. They've performed quite well so far. And at this time, I feel we're in the exact right place that we should be. If that changes, of course, I'll reach out to you. But if you have any questions in the meantime, just let me know. I'd be delighted to connect with you. Many thanks. Have a wonderful day. Take care.